Hi everyone, welcome to the Property Finance Podcast, and today I'm joined by Matt Irvine from Optimum Digits, who not only has become a friend, but also a very good client as well. So today I want to touch on everything accountancy and hopefully get as much free information from him as we possibly can and pick his brain a bit. So Matt, thank you very much for coming on.
Thank you.
Appreciate you joining us. So yeah, just talk us through, obviously you started a new venture in and around November, Optimum Digits. So yeah, just talk us through a bit about what you offer, what you do, and how you can help the listeners.
Yeah, so we are an accounting practice and tax advisory. We offer multiple services ranging from your just general standard compliance all the way through to a fully outsourced finance function and FD service as well. So I kind of really sort of more founded the business just more around the fact that I could see that a lot of businesses needed that extra level of advice and extra level of support. Yes, they had that from a compliance perspective, but they actually needed that more on a day-to-day basis. So I kind of really wanted to provide that service to clients. So we more focus on construction and property investors. So that's the sort of main services that we sort of provide.
Okay, so in terms of, so there's always that distinction between, I find when I'm looking for an accountant, and you mentioned accountancy, tax specialist, FD, everything else. So just talk through the difference between essentially that FD bit. What are you offering on a day-to-day basis as opposed to the tax side of things, I guess, more than anything else?
Yeah, so so we have three different packages. So the first package is the core package, which is all based around the compliance. So that's your general standard annual accounts being produced, your tax returns, your VAT, your CIS, etc. And then we, as you sort of progress sort of forward, because that's more suited generally towards a sort of probably a startup or a business that already has some sort of internal support already. So the middle package is all around sort of management reporting. So we provide management accounts on a monthly basis. We do a monthly review of the accounts and sort of give advice on a monthly basis throughout the year as well. And then the top package, our Elevate package, is more bespoke to the actual business. So we don't just do the compliance and the management reporting, we also look forward. So we put a 12-month plan in place and we report against that plan. We also look at cash flow forecasting. There's monthly accountability sort of sessions with myself as well. If there's any sort of level of sort of system implementation that needs to be done, we'll also look to do that as well. So perfect example of that is at the moment we're putting in place a stock management system for a client whose manufacturing facility is actually based in Turkey. So this was originally a property client, but they also had another business and sort of asked us to come in to that business as well with that on that top package. So we're in Turkey, we're implementing lots of systems for them. So sort of looking at their what they've currently got in stock, currently what their manufacturing facility actually does, and then sort of putting reporting in place for them so they can see what's happening in Turkey from their base in the UK.
Amazing. So obviously that's all very advanced, and probably most of the people who are listening to this are probably either just getting started or fairly early on. So from sort of a first-time investor, first-time developer perspective, one of the questions I get all the time is, what is a debenture? And really like talking around the company structure. So obviously debenture, as you know, fixed and floating charge over all assets within that limited company. But from your perspective, you must get asked all the time how to structure the company's group structures, whether to do individual SPVs and all that kind of thing. So obviously I appreciate it's always going to be individual to each and every company, each and
Absolutely.
every individual. But from your perspective, if you were to give just a couple of bits of advice around that for first-time investors and first-time developers, how would you kind of advise that they set up that structure? And we'll try and keep it as generic as possible. And obviously if people need specific advice, they know where to find you. But what sort of advice would you give people around sort of protecting themselves against debentures? Because it's without a shadow of a doubt the thing that seems to scare the most people, even though from our perspective we know that it's actually probably the easiest thing to get around and not worry about.
So in terms of sort of from a property developer's perspective, it's always going to be a holding company and a group structure. So especially if you're sort of looking to do multiple developments. So if you're doing multiple developments, each development needs to have its own SPV, which shares are owned by the holding company, and then the individual owns the shares within the holding company.
in terms of that, obviously one of the big things as well is the financing of that structure. And whilst that's great for obviously the development side of things, I think quite a few lenders get a bit funny if you're then holding assets as well. So if you had somebody who came to you and said, well, actually, we're not going to hold these assets, we're going to look to sell them as well, would you still advise them to look at that group structure, or would you probably get
absolutely,
them to move into a slightly different one?
Absolutely. So more from a group structure perspective, obviously it helps with tax. It also helps from a risk perspective as well, as you know, with lenders. So even if they are looking to sell the units afterwards, like myself, as a developer myself, I have my own holding company and my own SPVs for each individual site. So it's all around risk mitigation and the tax advantages.
And actually, from what you're kind of saying, probably those tax advantages probably actually outweigh the negatives of having to pay possibly slightly more interest on the buy-to-let mortgage or whatever when you hold it at the back end, because realistically, moving from a sort of individual company structure to a group structure, you're probably paying 0.5% a year more maybe, but actually those tax benefits probably far outweigh what you're going to pay anyway. So
it's also around sort of like that protection of them assets as well. So holding your assets in one SPV, and then you've got, say for example, if you're a serviced accommodation operator and you own your own assets in terms of property, it's you've got the trading business and you have your assets in a separate SPV. If anything happens within that trading business, your assets are always protected. So it's always around sort of risk protection as well,
which makes total sense. And moving on to kind of risk management as well. So obviously, again, the big proportion of people that listen to this are looking at getting into developments, and obviously one of the biggest bits around development finance is obviously managing those drawdowns and everything else. So this probably fits more into your FD role, I would imagine, probably more than anything else. And we'll kind of touch on in a future episode, obviously, your own experience in development and everything else. But from a drawdown perspective, how can you help clients in terms of managing those drawdowns? And because obviously there's QSs who can be there to kind of manage the drawdowns from a cost perspective, but what can you offer in terms of helping first-time developers especially kind of manage themselves financially through their first development or their 20th development?
It all comes down to actually managing the actual budget. So, at the start of them drawdowns, obviously everything's based off of what you expect that development to actually cost. But other than the drawdowns part of it, and sort of when a QS comes out, there's a lot of support that can be delivered throughout that as well. So from drawdown to drawdown, are you actually expecting to get the right level of drawdown for the next drawdown to what you're expecting? So, from a developer's perspective, obviously you have to get to a certain stage to actually get that drawdown, and kind of we can help to manage that process throughout that actual month between drawdowns.
Amazing. So in terms of kind of that support that you're offering developers as well, are you sitting down with them? I mean, this is obviously the business launched in November, with July, so we've got 9 months in. So it's asking a lot of information of probably a short period of time. But from what you're finding at the minute, are developers coming to you, especially in the current market and everything else that's going on around, are they coming to you fairly early on and saying, look, we've got this site, we're not really sure what to do with it? Are they coming to you and getting that advice around the structure, and kind of what advice are you giving people at the moment, especially with all this uncertainty in terms of how to structure things moving forward? Are they doing anything particularly creative? Are they doing anything particularly out of the ordinary? Or is it actually at the moment, while there's a bit of uncertainty, is it just trying to steady the ship as much as possible and just keep things as vanilla and as simple as possible?
Yeah, so in terms of what people are coming to me with at the moment, it varies. Some people are at different stages with their developments. Some people are already sort of partway through. Some people are just about to start, and they want to kind of get their structure put in place from day one. When it's from day one, it's a lot more easier to kind of do, because there's certain processes you need to go through if the business is already formed. So in terms of sort of vanilla sort of side of stuff, or them sort of side of transactions which need to be done, again, it varies. I have done some in terms of with alphabet shares of whereabouts investors have had a certain class of shares compared to the developer. For perfect example, one particular client, their investor wanted to make sure that they was paid out first before the developer. So we set up an alphabet share structure to create what's called preference shares which was up to the value of what their return was. So that their return was paid out before the developer was paid out. So it just kind of give that investor more protection, which is what they wanted and what the developer wanted. So we've had some quirky ones, I suppose, but a lot of them generally tend to be sort of the vanilla sort of standard group structures.
And you see that, because I'll be honest, I've never come across preference shares before, and actually we get kind of obviously quizzed all the time by investors and developers of how do I kind of persuade an investor to invest. And actually there's times where the investor can't have a second charge. There's times where the investor can't have personal guarantees or whatever. And I've genuinely never heard of preference shares, which kind of makes me question my own accountant to a degree. But in terms of that, I mean, that sounds like it could be quite good for people moving forward, actually, as a string to their bow or something to put in front of an investor. So
absolutely.
Is it relatively simple to set up and execute? Is it, or does it tend to be more expensive? Or what?
It's more expensive to kind of set up, but that particular instance and scenario actually came from the fact that they were so far through with their lender and they got an investor involved in it, and the lender wouldn't allow a second charge. So that's exactly what happened. So what then happened was the investor wanted to make sure that their funds was protected and that they was going to get their return first before the developer got his return. So in that particular instance, that's why that was then set up. So the A shares was the developer shares, the B shares was the investor shares, which was classed as preference shares.
Yeah.
And then within the shareholders agreement, it was stated that effectively the B shares needed to be paid out first as being preference shares,
right,
but only after the original loan was paid back. So no dividends was able to be actually paid out from the business until effectively the loan was originally paid back.
Right,
so it was a way of protecting the funds within the business from the investor's perspective.
Yeah, and it's something I've never come across, so that's actually quite good for me as well, a little golden nugget for moving forward, because it's incredible the amount of people who come to us and say, well, what can I present to this investor? What can I present to? And I suppose that would work quite well on JVing with landowners as well, I guess, because actually sometimes they can't take charges or whatever if they're bringing the land into the deal. Actually, if you can then offer them preference shares, actually it's as good as them having a charge over the land to a degree anyway. So actually that's a bit of a game changer for me. My mind's now kind of going off in lots of different directions as to...
There's many options when it works. Like the bonus with Alphabet Shares is that it's very flexible in terms of what you can do. So you can give different rights, different rights to dividends, different rights to voting, different rights to capital. It's very, very flexible. So
see, I knew about the voting and I know about the dividends because we've got Alphabet Shares within the brokerage. So I'd kind of been made aware of those as well. But I'm sure when I've asked about preference shares before, I've been told we can't do those. But maybe it's because we're a service business rather than the property business, or maybe I've just got a crap accountant, one of the two. But yeah, it's one of those. So that's, definitely a massive golden nugget for me. Sort of moving forward, whenever anyone's going to ask me now about JV with landowners, I'm going to go, have you thought about preference shares? I've got a couple of other questions that I want to ask. One's going to put you on the spot. Well, actually, both are going to put you on the spot. So I'm going to put you on the spot a bit more intensely to begin with.
Go on then.
Give us a horror story of something that you've had, and this is going to put you on the spot because you're going to have to now delicately tread around giving away any details. But are there any horror stories that you've had recently that you can kind of share with us that will give people, this is what you don't do, or this is what you should avoid? Is there anyone who's kind of gotten themselves in a real mess that could have been avoided? Well, I suppose here's an opportunity to say yourself, could they have gotten themselves out of the mess had they come to you, sort of thing? Because you must get some people who come to you and you think, what the hell have you done?
Yeah.
Because we get it. We get people come to us and
there's many and kind of thing. I'm just trying to kind of like think of the worst one really more than anything. But certainly sort of like with structures, there's a lot around sort of structures or whereabouts. I've seen people set up group structures and with a holding company and then put all of the assets and the liabilities in the holding company, which just makes absolute no sense.
That puts everything at risk, yeah.
But it all comes down to sort of like an understanding. But I think the biggest sort of horror stories that I've kind of seen in the from what's sort of been coming over is just purely them coming from accountants which haven't kept their books up to date.
Yeah.
And that brings many challenges throughout that anyway, not just from an understanding of how the business is actually performing, but all the way through from that to making sure that you're tax efficient, et cetera, et cetera. So it kind of like snowballs effectively. And I've had numerous ones like that have certainly sort of come over of whereabouts. We've seen sort of certain, within their actual accounts, it's showing age creditors of like £250,000.
I can imagine you see some
nowhere
horrific,
near that, you know,
some horrific directors' loans accounts and
all of that
things
sort
like
of
that,
stuff,
I can
and
imagine
not
as well,
necessarily actually correct. There's a lot of stuff that's kind of come across that's certainly I've seen that sort of side of stuff, and it's no wonder that business owners don't actually understand how their business is performing, because what they're actually seeing is not actually right. So or they're not seeing anything at all.
Which is what you mentioned. Yeah, and that's something we've had as well. And I did my 30 posts in 30 days the other month, and kind of ran through. And one of the things for us, and I've spoken to you about this actually as well, is that we weren't seeing management accounts. Yeah. And you and I have had numerous conversations, and we're in the process of moving all of our accountancy stuff over to you for obvious reasons. And one of those conversations was around the fact we weren't getting management accounts. We weren't actually aware. We were coming to the end of every year and sitting there and going, what have we actually got? What's going on? And not having that. And it's really bizarre as well, because even though we are brokers and we deal with finance every single day, it's something completely different, because in your day job every single day there is someone there who is an expert in that side of things, who we just haven't had that level of support. And it's so difficult, I've found, to decide when to expand the business, when to contract the business, when to invest, when to hold funds, etc. It's impossible. And like you said, you've got to have that knowledge in order to build out that financial plan, in order to actually know what you're doing. Because this is your elevator package where you're talking about the fact that you're giving out like management accounts and helping them grow against a 12-month plan. And I think that's the bit that is going to benefit most people, not just service businesses, which obviously would benefit kind of our stuff, but I think property developers as well, because I've kind of taken on as most people who listen to this will know, I've kind of taken on an FD role as well, but I'm not a qualified FD. I'm not it's not my specialism at all, but it's that I sit with developers and I create that 12-month plan and go through it with them and help them to understand, right, okay, well, if you refinance here, you can then expand here, there, etc. Whereas yours is, I suppose, more of, right, okay, well, you've got this much cash coming in, you've got this much tax to pay, you've got all of these other things. And I think that's, for me, probably one of the most valuable things that I think every business owner can do is have that 12-month plan and work against the management accounts and things. And I guess that kind of eventually leads into a question. That's a long way of getting to a question. But the question I kind of had off the back of it is, obviously we've spoken about the biggest horror story, but what's kind of the biggest success story that you've had so far in terms of what do you reckon the most you've saved someone is? Because I can imagine it's probably into the hundreds of thousands of pounds.
Massively with group structures, like is it sort of like just purely from a group structure perspective. Obviously, you know, when we're sort of looking at developments, you know, that's hundreds of thousands of pounds in tax that people can save, especially if they've got multiple developments on the go.
How does it actually save them? Because this is the bit that people won't understand, and I guess this is where I often forget to bring it back to layman's terms. I kind of assume that everyone who listens to this kind of understands at the same level, but actually there will be people who don't understand why that group structure saves money. So if we kind of dumb it down into its basic format, someone's got a holding company, which let's say it's themselves and their spouse, so two people in a holding company. That holding company then owns 100% of an SPV, which is a special purpose vehicle, which is essentially just, for all intents and purposes, a limited company. Correct, that's just set up for one thing, really, isn't it? With the plan to kind of do the development and then close it down and move on, sort of thing. Yeah. But how does that actually save money? If I've got a development in that SPV and I then sell that development, obviously there are taxes due. If that limited company was on its own with no group structure, what's the difference? What am I saving? What am I?
So what you would do is, if you didn't have the group structure in place, when you closed that business down or when you took your dividends from that SPV, effectively they'd come to you personally. So you would then get charged dividends at the rates for your particular where actually sit in the tax schemes. So in terms of what the saving, when that dividend's issued, it's issued to your holding company instead, which is issued with no tax on it. So it'll go up into your holding company for you to then reinvest back down into a new SPV. So let's say, for example, you've just completed a site, you want to take the funds out and invest it into another site, and for that equity part of it, if you don't have that group structure, you would have to take that out and pay tax on it personally.
And then reinvest it.
And then reinvest it again.
Yeah.
Whereas if you had a group structure in place, you wouldn't have to pay that tax on that dividend going up to your holding company, and then you'd be able to put 100% of the funds and invest 100% of the funds back down into the new SPV.
And you'd still presumably need to, no matter what structure you've got, you'd still presumably need to pay some form of tax on the profit.
Yeah, you'd have to pay tax within the actual SPV. But obviously that's when we can sort of look at things like any pensions contributions you want to do or anything like that to kind of deduct away from.
And am I right in thinking?
Profits.
Yeah, and am I right in thinking that with the pension contributions, that if you have a SAS pension, you can invest? I think is it 3 years in reverse?
Once it's set up, there's the possibility of doing that. There's certain conditions that you need to hit.
It's not as simple as I make out, but hence I'm not an accountant.
But yes, absolutely. Yeah, that's something that is possible to do.
And do you need to set that up before? So in terms of, sorry, we're delving into pensions now, which is maybe a little bit of a different conversation, but in terms of, let's say I'm doing my first development, do I need to have that SAS pension set up before the development commences, or is it right? Okay, so it's not something that you can't start the development and then set up a pension.
Correct.
It's a case of you've got to have that pension in place, and then the development commences. After that.
In terms of sort of like how we work with SAS pensions, we have a SAS pension expert effectively, who's kind of external with it, so we don't get involved in actually getting that set up or anything like that. But yeah, there's certain conditions that you need to make sure you're hitting to be able to actually contribute towards it.
Amazing. So that group structure is going to save people quite a bit, especially if they're looking at reinvesting and doing lots of other bits and pieces. And presumably, you set that group structure up. So let's say if you've got, because where we find it tricky is you end up into like a spider web of companies where you've got maybe an investor who they've got an SP or they've got a holding company, someone else got a holding company, and then those two holding companies come in to create another holding company. So when you get that, are you advising people to bring those holding companies to create one new holding company, or are you advising people actually probably to avoid doing that and actually set up their, I get it's probably specific to each person, but 9 times out of 10, are you sort of saying to them, well, actually just set up one holding company? And
It's very dependent on the individual. So, or I say the individual, but what's actually going on, because as you know, sort of lenders don't like layering.
No, at all. No, they get really freaked out pretty quickly. Yeah.
So, if you've got too many holding companies, it could effectively be treated as layering from a lender's perspective. So then you'll struggle to actually get lending. So, what I sort of recommend is, let's say, for example, if a few people or 2 or 3 people come together to sort of do a development themselves, I'd always recommend for each individual to have a holding company.
Yeah.
But whether they create a holding company underneath is more around from a lender's perspective, or whether they actually own the SPV, each SPV through their holding companies.
Yeah, which would probably make more sense and be a bit cleaner for them. So, okay, right. My last question. You're going to love this one.
Go on.
This is going to be a fun one. We're a week at the point of recording, a week after Labour have entered government. I knew you were going to love this one. This is a doozy, this one. In your personal opinion, you can see I'm approaching this with trepidation. What do you see? And I'm kind of asking for predictions as well as based on their manifesto and kind of what they've done so far and everything else. What are kind of your predictions moving forward, and what are you most excited to see? What are you most worried? Trying to get your general feel for post-election Britain.
Yeah, I mean, it's still early kind of thing.
It is
to sort of see how this is going to sort of pan out, but obviously there's going to be changes in terms of what they've done. I think they're going to probably more aim towards sort of capital gains tax.
Yeah.
Historically, that's something that they've never really liked. So they've certainly sort of spoke historically about sort of increasing them rates from what they currently are to bring them more in line with kind of income tax rates, which is a significant increase, and obviously going to significantly hit property investors if they look to sell properties that are in their personal name.
Yeah.
So that's one thing I think that needs to be sort of considered and sort of looked at. In terms of what I'm excited about, I don't know.
I tell you what I'm excited about, to be fair, actually, and this took me by surprise, was they came out pretty publicly, sort of back end of last week, I think it was. Obviously, I have to bear in mind that this isn't going to go out sort of straight away, but sort of very quickly after getting into office, they came out and they obviously made this whole big song and dance about house builders.
Yeah.
And that is one thing I'm quite excited about, actually, is that they do seem genuinely like they want to do something about the housing market, like they want to actually get some housing built and sorted. So I guess my question to you is, do you actually see that happening?
It's needed.
It's needed. Just a bit, yeah.
But do I actually see it happening? The government will be the government. Like, that's what it comes down to.
And that's always everyone's response. It's always, who knows? It'll be what it'll be.
They'll bring their, like the changes that they'll bring them in. We'll have to change a lot of stuff to obviously sort of make sure that everything's in line with everything that they're sort of proposed with their budget. Well, I say proposed, but putting in place because of their budget. But in terms of sort of, from my opinion, from that housing point of view, I think they've got to do something.
Yeah.
And yes, if they do, that's something I'm definitely excited about as being a developer.
Yeah,
absolutely. But I think it's going to be a case of whereabouts. I don't think it's going to be as straightforward and as simple as that. I think to be able to actually benefit from it, I think we're going to have to pivot in one way, shape or form. But time will tell in terms of what that actually is.
Always seems to be the case these last few years. We'll see what next year brings. It always seems to be the way since 2020. But it pretty much brings us to a natural close, I think. So the last thing I just want to ask you, just for everyone who's watching and listening, what is your ideal client at the moment? And to be fair, it may be that obviously given you've got 3 packages, you might have 3 different ideal clients. But for the guys that are listening to this, at what stage should they be at really to be engaging with you? Can they come to you as complete novices, or are you looking for someone who's maybe a little bit more experienced? Or
Yeah, good question. So because of the 3 packages, it is 3 different types of people, really, and that's whereabouts the packages really sort of come from.
Yeah.
So the first package, being the core package, is generally sort of there for startups that are sort of there and wanting to kind of grow throughout. And as their business grows, the idea is that they grow throughout the packages as well, because it offers different levels of support. So certainly sort of like with the 3 different types of people, it's always around sort of them wanting to be ambitious, wanting to grow, because we always say that as you grow, we grow with you. And, one of our things that we always kind of say is, we measure our success from our client's success. It's as simple as that. We can't measure our success any other way. We're all about being there for our clients, supporting our clients, being there for communication, being there for any level of support, regardless of whereabouts they are within that journey. Yeah. But certainly from a core package perspective, it's always going to be sort of a startup type of person. Then with the middle package, it's generally sort of tends to be around the sort of people that are out of that startup phase and sort of starting to potentially sort of scale up. Yeah. So they want to see how they're performing, but they're still relatively small at that stage. And effectively, that's generally tends to be more of a construction client, really, more than anything, who's kind of just starting to get some bigger projects under their belt. They've gone from one small site to a couple of medium sites or something like that. Maybe even that they've gone from sort of like some buy-to-lets or something. Yeah, exactly. And then we've got the top package, which is more for kind of like a more of established business or a more ambitious business that is growing fast, and they kind of need that day-to-day support. They need that 12-month forecast, that cash flow forecast in terms of where when the money's coming in, where is it going out? How do they stop that? What can they do in terms of saving, cost reductions, etc. So yes, and again, it's just all most of the time it generally tends to be all around construction and property. However, we do have other clients. As I said, we've got a manufacturing client, we've got a chiropractor as well, who's sort of in that scale up phase and is really sort of ambitious to grow. So he's in that.
So not
sort of
everyone
middle.
fits into those 3 boxes.
Yeah, exactly, kind of thing. And from our perspective, it's all around sort of being bespoke and being there to support our clients. I'll go on site to see clients, sort of look around look around their actual site. We're there for our clients, and as I said, our success is, I measure our success through our client success. That's exactly what I do.
Love that. Brilliant. Well, thank you very much for coming on. Really appreciate it.
Thank you.
I've learned a lot. So if nothing else, this has been great for me, to be fair. So I've essentially just had 30 minutes of free advice, which is great. So made sure I've asked all the questions that I wanted to ask. So yeah, love it. Thank you very much for coming on. And
thank you.
For everyone,
it's been good. Enjoyed it.
Listening and watching, thank you very much. And I'll catch you on the next one.